Hello, welcome to another episode of Daily Market Mastery. To be more precise, episode number 24, take B, I would say, with me, Christian Rauchenwald. As always, in today's stream, usually in Daily Market Mastery, we would use Elliott Wave Theory to try to predict the potential future course development of separate or different stocks and indices. However, usually on Mondays, I get it's not Monday, but usually on Mondays we do our portfolio review, which we did yesterday. Unfortunately, however, I didn't notice that after the latest OBS update, the microphone wasn't working, and therefore we're gonna repeat, that today. So before we get to that, as always, usual disclaimer: everything that I share in this live stream / video is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. That said, everything I'm using in this live stream, so the softwares I'm using, the tools I'm using, and so on, is linked in the description down below. And you can also find a link to my portfolio to check my personal track record. And if you want to do so, copy it directly, so you don't have to manage your own portfolio, but you can just copy mine by using the link in the video description or in the pinned chat message that you can see here right now as well. That said, yesterday I said, we already had this episode, so it's gonna be a little bit different because I already performed some actions and we'll have to, just show you what I did. So we actually have it on recording, and with that we just jump to the screen, and there right now you can see my overall performance over the last couple of years. So this year so far isn't going that well, as we see, with minus 18%. It's like nothing out of the ordinary. If you check my history over the last couple of years, you will see that sometimes it happens that we have like bad months in between. The worst period we had was actually in 2021 with 4 losing months in a row, although the loss was not that big here. But we also have single month losses in the past of minus 11, minus 10, minus 14% here. Overall, that hasn't kept me from outperforming the markets, and I don't think it will keep me from outperforming the markets this year either. Now, as far as the portfolio goes, right now we still have those positions. However, yesterday, history, we closed the positions in Shopify and took a profit off. 1 second, I just have to find the Google Sheet on my Google Drive, because I don't have it open yet, where I keep track of all our positions and my forecasts for them. So we closed Shopify and took a profit of 33.4% if we consider both positions. And because we consider it might go down, I'm going to fire up Motive Wave, the software I'm using for most of my trades, and we're going to look at all our position there again real quick. Also forgot, 1 second. Just muting my phone. And here we are. So as usual, let's start with the SPX, and here we quickly circle back actually to our overview. So we see we have positions against the SPX and against the NDX by investing in the ETFs SPXU and SQQQ. Those positions are currently at a loss. However, if you look at my portfolio, not here, but here, you'll notice that on average, we actually have a lot of those trades in profit, and our average profit is bigger than our average loss. So even considering the current losing positions, on average, I'm making a decent profit from my investments in those two. Now, anyway, so for the SPX, we have said, or I've said, okay, we've seen an all-time high, and now we're actually in a huge wave 2 on the way down, and the way down will be very, very far, in my opinion. And so far we've labeled 1, 2, 3, 4, 5 as a leading diagonal for wave 1, and we're not sure where wave 2 ends. We thought it might have been here, but we didn't bother to really confirm that, and now we just drag along our wave 2 point. Overall, I'm gonna add a horizontal line here and extend it. Let's do it like this so that it's the green dots are not annoying me. There we go. And so basically, based on the rules, guidelines, and everything I personally know about Elliott Wave Theory, we would expect a turnaround either at the 38.2, 50%, 61.8, or anywhere in the area of wave 4, which would be this horizontal line, which means we still have room to go up here. And even if it goes slightly above that, it would still be fine. I mean, it would suck because it would mean a temporary unrealized loss, because our SPXU position would go more into the negative. But overall, I'm still fine with that. Would have loved it to go down further earlier, but we'll see how it plays out. So we will see how far it goes. right now we would also still be on that trend channel that we have been drawing based on 0.2, I mean removing the trend channel actually with 0.2. And yeah, once we start going down here, assuming I'm right, we would actually eventually wait towards a breakout to the bottom. You can see that's a like 25% drop in value for the SPX, and considering that the SPXU is a leverage product, it would actually mean that our current minus 24% position would actually not just be break even, but actually the plus if or when we reach that line down here. Now, obviously, there has to be some negative news for this to happen, and negative occurrences in the economy, which is bad. It's kind of like a little bit in the Big Short, where the people are celebrating the, betting against the US economy, yeah. But it is what it is. That's what I'm doing here. And yeah, like if I can profit from that, like, yeah, why wouldn't I? Yeah, so obviously it could also turn out that I'm wrong, and in this case I will eventually have to take a loss here, but we'll see. So far I'm confident in my position and I will keep holding that one. In the NDX it looks similar, although in the NDX we didn't even try to label wave 2, and the NDX we covered a little bit stronger. We're already a little bit above that wave 4 line here, so we labeled the 1, 2, 3, 4, 5, although we did not try to say, okay, this is wave 2, because that just didn't check out very well for me back then in the original episode when we looked at it, which was episode number 5, SPX and NDX. I think we both analyzed in episode number 5 on the 29th of March. So we've already been waiting quite some time here and see things move against us. It's okay. We have the next target would be the 61.8% line. We're not very far away from it. That would serve as a potential bounce. But even if we go a little bit beyond that, that would still be fine. Yeah, it's hard to say where exactly I would worry, but probably, yeah, like somewhere, way below 15,000, but slightly above 14,000 in the NDX is where I would start to worry if my labeling here is somehow wrong. But the overall situation is still the same. That my overall expectation is that, like we are actually at the end of a very long wave 5 and are now in a corrective cycle downwards. So we'll just have to wait and see how that plays out. Now that brings us to our next position, which is Shopify, which is said we closed yesterday at a profit of again 33.4%. Why did we do that? If we jump to Shopify, we can see a few things. First of all, we have this very big labeling long-term 1, 2, which means we're expecting actually a third wave that takes us up here, yeah, which means I'm long-term bullish on Shopify right now. In addition to that, I labeled the chart like this to say, okay, that's the 1, 2, 3, 4, 5 leading diagonal. That actually finishes the 5th wave here, which then becomes wave 1. And we're now waiting for wave 2, which should ideally take us down again. That wave 4 would be a point, but also the 38.2 to 61.8 retracement. So anywhere between $45 and $35, depending on how that plays out. Now, I could be wrong and it goes up further, which means we would have missed out on some profit. Okay, that would be fine as well. Can't always make the exact perfect moves. And either way, if I'm right, it means we wait for the drop down here, which is an almost 50% drop to happen, yeah. And probably considering that wave 3 should usually be one of the strongest and we have a gap. So we have multiple reasons to assume that we'll get down there. First of all, it would close the gap. Not all gaps always get closed, but it's an additional indicator, or an additional thing. Okay, it actually would make sense to close the gap. So if other things point towards that, then why not? Then the 38.2 retracement would actually support closing of the gap. And the labeling of 1, 2, 3, 4, 5 here actually supports that this is the end of wave 5. Although, however, if we consider that wave 3 is usually the strongest movement, it's possible, and bear with me here, that basically this here somehow is 1, 2, and then wave 3, 4, and now we have wave 5, in which case there would be a little bit further upside here. So if we take a trend channel here and say, okay, that's our 2, and that's our 0.4 with a parallel through 0.3, and extend that, then our target here would actually be somewhere here, with like another 20% upside before we go down. Which means we would have missed out on potential 20% profit, not on our entire portfolio, but on the 1 or 2% that we had invested in Shopify. And in which case, after that, we would go down and we would buy again. Yeah, like either way, we would have to look closer and try to label this out. And I'm fine with the decision to take the profit here. So let's just undo the changes that I made here, and we'll just wait. If we go higher here, it's fine. We'll just relabel and then adjust, and eventually, obviously, then also if we go to 70 something here, then our target here changes, but it still is enough to potentially close that gap. So our re-entry would then probably be at 48. Right now, we'll keep a weekly look at the chart here, and I'll have an alert at 45 actually. And yeah, like if that alert triggers or if the chart updates, we will re-enter the Shopify position long. Worst case, if we get everything wrong, we would actually re-enter when we have a breakout here at the top, which will probably take a couple of years to get us there. But I said with Shopify, I'm actually bullish long term. So moving on. Back to the portfolio, we have our position in Black Knight Inc., which currently has minus 8%. We see here, we have a similar situation. Our long-term labeling says, let's get rid of the volume indicator. Our long-term labeling says we have 1, 2, and now we might be in wave 3. We are already retracing way more than we would expect. Again, we usually would expect our turnaround then here at yeah, like 38.2, 61.8. Considering that this might be 1, 2, 3, 4, 5, and then yeah, like that corrective pattern is just way worse. However, we still have till 52 only if we reach 52 or slightly below that. So once we go below that, our wave 2 here would become invalid, and we would have to adjust. At which point we would hit our stop loss, which is okay. Again, nobody can always be right. Hi Akashi, great that you made it, and great that the audio is working today. Yeah. So we cannot always be right, and then we would just take a small loss here. However, if we turn out to be right, our profit target would actually be up here, so north of 100%. Again, not 100% growth on the entire portfolio, but on the 1 or 2% that we have invested in that position. So far, we'll just have to wait that out. Right now, to be fair, it looks more like we will hit the stop loss with that position, but yeah, it just happens. That's why we have a stop loss, that's why we enter a trade based on our analysis and say, okay, this is our profit target, this is our stop loss. And all that matters is that since our risk-reward ratio, so like how much we stand to lose versus how much we stand to gain, usually is very, very good in our favor. So like something like, at least here, it's like, I don't know, like 1 to 5 or so. So when we opened the position, our overall risk was like less than 20%, while our potential gain was more than 100%. So it's actually better than 1 to 5, which means we don't even have to be right 50% of the cases to long-term look at a decent or huge gain. And if we look on average, I'm profitable so far 55% of the cases, and my average profit, as you can see, is 560% in that case, with the average loss 39%. Although that number is skewed by dividend split off from AMC that was considered with, in quote, zero buying. Yeah. Overall, still my like profitable trades are more profitable than my losing trades. And yeah, so there we go. Circling back. Yeah. So we looked at Black Knight. So they're just waiting. Next thing that we have in the portfolio would be Domo. So we skipped GameStop. GameStop, there's a separate episode I made about it, which is episode number 9 on the 5th of April. You can check it out if you just look for episode number 9. Yeah. And so Ford, we don't have a position right now. We're actually waiting how this plays out. No, Ford, we have a position. Sorry, we have one here. Yeah. So we're currently at -8. And we actually think that this is how it plays out, so that we have a what's it called, combination corrective pattern. So it's not one corrective pattern, but a combination of corrective patterns. And then we here basically are now waiting for the breakout to happen. That should happen to the top. And if it were to happen, we obviously would again be similar situation, wave 1, 2, and now in wave 3, we would have a huge profit target. Our stop loss is at 1061, so we don't stand to lose a lot more. However, again, risk-reward ratio, if we are right here, our profit here will be very, very big. Now, again, we skipped GameStop, and which brings us to Domo. In Domo, we already, I will address that in a second, yeah. So we already took some profits. So if we look at the history, we see in Domo, we took profits of 14.78%. Why? Because in the long run, we have a similar situation that we're saying, okay, 1, 2, and now we're in wave 3. But then I actually figured out or labeled it as, okay, this is going to be wave 1, 2, and which is another wave 3, which brings us then on an even smaller scale into this wave pattern where we have 1, 2, and are now currently in this third wave here. However, originally we entered the stock here and sold then here. So we took that profit here and then re-entered somewhere here again. And now basically, if we are right, we avoided that entire loss here, which would have eaten up the 11 point or 14.78% and actually a little bit more, and have now new positions in Domo that currently are the portfolio Domo already 7% in profit again. And yeah, like here our profit target would be at least the $20 mark. So we have another 30% upside here. Our stop loss should be still at 11.59 if I'm not mistaken. So yeah, like, so we're good to go. And worst case, if that thing turns around against us, we would stand to lose the original investment or original profit that we made from here. However, if we would have kept that position open and it turns out that we are wrong, then we would have lost actual more. So this way, it's like now worst case break even, best case if we're right, that's going to be a very, very profitable long-term trade. We're in between, depending on how we are able to detailed label out the corrective patterns and everything, we should be able to take a profit and then again wait for a wave to correct and then profit and so on. So we'll see how that goes. As for GameStop, GameStop is a very unique stock on the market. I mean, while we labeled it and there are patterns that suggest, hey, there's going to be a lot of money for us to be made, and which is one of the reasons why I'm holding a lot of GameStop. Not in this portfolio, where there also, I think there, how much do we hold GameStop here? Here we are holding 10% of the portfolio in GameStop. And while they appear to be at a loss, we actually made huge profits with the GameStop positions in the past, already 2 years ago. So, which are mostly like most of the 2021 return is actually GameStop in January, because then for the rest of 2021, I was very, very busy with our other businesses and therefore didn't manage the portfolio that actively. But yeah, so GameStop is like very special because there is like, millions of shares directly registered, which means they're not held by on any broker account or so, but they're held at the transfer agent of GameStop, which removes liquidity. Yeah, and which means it makes the stock more volatile. So, and yeah, and every month more and more GameStop shareholders actually directly registers their shares. And I'm still planning to, I don't know why I'm not doing it just right now today, yeah, but I'm still planning to actually close the position on my eToro account and actually then buy them also on ComputerShare again, so they're directly registered. And therefore, the mass psychology aspect that Elliott Wave Theory relies on doesn't apply as much anymore. Yeah. Now, I used Elliott Wave Theory originally when that whole thing here played out, and I used it quite successfully to really determine where things are going. Until here, the buy button was disabled for GameStop holders and holders of some other stocks. And then only selling was possible, and it screwed the whole thing up. And then since then, a lot of development and, in my opinion, manipulation happened. But yeah, I'm overall bullish on GameStop, but Elliott Wave Theory doesn't apply that much anymore. So while I have the labeling and we have an episode about it where I'm also pointing out that it's like not as straight cut as other things are, it's like where we are now, and we'll just have to wait how that plays out. Now, moving on, so we have Domo, we have Ford. What's the next thing? Neo would be the next thing, for example, or Disney actually is first. Let's first look at Square here. My prediction is, okay, that we are going down to the $30 mark. Most analysts predict that we are going up to the $170 mark. And as I said before, it's possible that the corrective pattern actually is not finished here. Or not even finished, but that the corrective pattern actually will play out like this, so that we might see 170 before we go down. Yeah, definitely possible, but that I'm not convinced of that enough to risk investing money for that upwards trend, because in my opinion, we still have to see that correction that takes us down somewhere into that area. So here we are basically, what are we tracking here? The retracement to the top, okay? So that's why we have that mark here. So we'd actually expect it potentially, if that is wave A, to go up here and then go further down. But if that already is, whatever, like, I mean, it can also be another corrective pattern. As said, my outlook here is overall negative, even with the possibility to make like, that would be like 200% gain up here before we drop down, which would make the drop more drastic, to be honest. So either way, like, we'll just wait and see here. I would enter if we approach the $30 mark. Yeah, if we go towards the $30 mark, I would open a position here. That's why we have it still open and keep an eye on it. If not, then yeah, we won't. Yeah, and great. That then brings us to Netflix, where we don't have a position because we have a similar situation. I think that this is wave 1, 2. Yeah, on the biggest scale, which means we expect it to go down, and we expect it to go down a lot. If we zoom out here, zoom out like this. Yeah, here we actually, yeah, so we can see here it says invalid labeling, but that's because the data that I have here isn't properly adjusted for the stock split. That's also why that 0.0 is lower, because that's actually the starting price. And that's actually how that retracement looks like. And if we look at that retracement, we would expect basically to hit the 61.8, which would be at $6, which would obviously be a huge crash for Netflix. And yeah, like it probably might turn out something like this. This is what we currently have labeled. And if that's the case, then this here might just be wave 1, 2, although we would have to adjust it because again, we see the breakout here. So wave 0.2 would move here, and we would then expect, and that actually 0.1 is here, which again, we see that would be perfectly fine. So first of all, 1, 2, 1, 2, 3, 4. So we would expect, and then 5. So we would expect that this here is actually where we will turn around the $400 mark. So there's still 10% upside in Netflix, in my opinion. Again, might not reach that far, might go a little bit further, but then I would expect it to actually turn around and build out that wave 3 that eventually will make up wave A of the ABC corrective pattern, if it is an ABC corrective pattern. And yeah, so there we're still waiting. Now Disney, we have a position. Let's check that real quick. So in Disney, we have a position. It's currently down 5%. We currently have a small position in Disney, and we don't have it labeled here because we don't have proper data. So Disney is labeled in, where do I have Disney? Disney. Okay, I don't have it written here. Maybe my yesterday's change to our data sources screwed that up, so maybe we don't have a labeling anymore. Yep, looks like it, yeah, which is a pity. But basically what we would expect in Disney was like, this is 1, 2, 3, 4, 5, which would again give us a profit target at around like a 90% drop for Disney, which would mean if that's 4, then we would have 1, 2, 3, 4, or 3, 4, 5, which would again short notice expect us a drop here, which would be the wave 2 from here. So like 1, 2, blah, blah, blah. And then basically play out longer downwards. We'll have to see and keep an eye on it. No, wait, we have a position in Disney, so that we labeled that different. Like, it's a pity that my data that didn't get stored. So we are currently holding a Disney position, and our stop loss is at 79.07. Where do we have 79.07? Here probably. Why do we have that? It's hard to remember all those things, so don't nail me on those. Yeah, so 79.07 should be that low here. Are we looking here on the smaller part? So we are looking here and saying, okay, this we label it from here, 1, 2, 3, 4, 5. And now we have a corrective pattern here. And if that corrective pattern already finished, then we will go up from here. It might have been that I made a mistake there. I might have to revisit episode 18 where we actually did that. So to better recall why we did it. Yeah. Because 1, 2, 3, 4, 5. Yeah. And then we would expect ABC to take us up to 1, 2, 3, 4, or 3, 4 to take us up to 120. Where's our take profit for that position? It's at 270. So we actually expect, okay. I'll have to revisit Disney. I'm currently really, since my chart data is gone here again here, TradingView doesn't provide accurate data and it doesn't adjust properly for the splits, which is making it impossible to label it here. But if we label it from, why did we label it from? Oh no, we probably labeled it from here. 1, 2, 3, 4 would be too short of a corrective pattern. 3, 4, or maybe that's 3, 4, and we still expect wave 5. I think that's more likely. So because of that, the duration of the pattern. So yeah, I don't think that played out already as wave 1, because if we then decompose that one level, it just doesn't look nice. Especially, we couldn't then properly decompose that. So I think that this here should be wave 1, 2, and then, yeah, I'm not sure if that is 3, 4, because we would need a very weird corrective pattern here to have that much of a high. But so maybe. Again, I'm not fully recalling what we did here. So. But if that would be 3, and now we would say, okay, this here should be 4, and now we're waiting for wave 5, in which case, yeah. So to be certain, please consult if you're worried about this name, or consult episode number 18. So yeah, so that's why where we at, we would basically say, okay, this is what we're waiting for, and close that. And let's check if we take a Fibonacci retracement. Now, very often wave 4 would either, depending on if it's a regular one or so, would either be the 38.2 point here, which would give us the take profit at 268, yeah, and our take profit is at, what did we say, is at 276, yeah, so I mean roughly 268. So that seems to be the case, so that we actually are looking at it like this and expecting this to be wave 4, which also, I mean, doesn't fully explain. Then our stop loss would actually need to be at 18.407. Okay, I really will have to revisit that one episode. Yeah, but yeah, it appears that in episode 18 I was able to label it in a way that makes me bullish. Might have been a mistake. Again, nobody's perfect, but we'll see about that. Now, moving on. Yeah, we had Ford, we had Disney. So next thing would be theoretically NEO, which we also already have here. And in NEO, we are also bullish because we believe that this might be how it plays out. Doesn't have to be correct, to be honest. Yeah. So I mean, we have a very short corrective wave A, and then wave 2, and wave 4 would be really ridiculously long. But yeah, like the 61.8 retracement, where's our stop loss for NEO? So like just double checking here, it's at 550, yeah, so slightly below that point that we have here of 555. And actually we cannot reach the 555 because then that would not be an impulse, so it should be 565 at worst. So we can actually adjust our stop loss here. I will do that on my end real quick. So NEO stop loss should be 565, because if we hit that, it's not an impulse wave anymore, but a leading diagonal, and that brings us into some trouble with labeling here. And so yeah, so our stop loss should be 565 updated now, which means our risk is 28% of our total position, and our position size was back NEO, we have 1.3%, so we basically stand to lose 0.35% of the portfolio's value if we're wrong. However, if we are right, we can see that we basically have a potential 1000% upside. So we would at least recover, I think the minimum is 70% that we recover. So worst case, we would be somewhere here-ish. With still 200% upside. Best case, our wave 5 actually obviously will build over time a new all-time high, which would be an incredible upside. Now that's all the positions that we have right now. Now again, the Disney position is something I'll have to, yeah, you can hunt down that mistake, since that's what you usually do for me. That's really, I really would appreciate it, yeah. Yeah, so that's all the positions we have. We also looked at MU, which is micro something something, and here our labeling also got screwed up because of missing data points. So yeah, so when I add Google as a data source, we get historical data, but the problem with that is, or zooming the wrong way, is that it screws up the data for the SPX, so I had to remove it again. And now we have here a lot of data points that don't have any, or a lot of values that don't have any data. So in MU, we're currently expecting, hey, it might play out like this. So we're looking at wave B and then a wave 4, wave C that then finishes the wave 4. And then we would potentially, do I have an alert for that? I think I have an alert for that. Let's check MU. Set price alert. Yeah, we have one at 35. So 35 would be the point where we would say, hey, let's look into re-entering that position, or entering that position long to benefit of a potential 5th wave. And JPM is also something where I'm currently expecting a drop. So, and there our labeling looks like this, where potentially we might have a new, not a new all-time high, but we might get close to the old all-time high before we then go down and to the $100 mark again. And our alert here is, I think, at $100. So I'm gonna check that real quick. JPM, set price alert. 105 is the alert that we currently have. And so at 105, we would start to revisit the possibility to enter again. Might be wrong, and we might go up further, in which case we would then already know, okay, we're now the fourth wave already finished here, and then that would be 1, 2, and we would eventually see 3, 4, 5. That takes us above here, and then we can determine entering the position late. Yeah, would be some missed profit, but still, and determine a profit target based on wave 2, 4, and 3. Yeah, and that's everything we looked at so far. And as you see, just that summary takes already 30 minutes. That's why we do the summary now only once per week. As said, I did it already yesterday, and it's a pity that I forgot to make sure that the audio is working. Yeah, again, yeah, it's a mistake that I probably only make once. Now I know after every stupid OBS update, I have to double check that all the microphones and everything is working properly. Now I know that. And yeah, so tomorrow we're going to look at some new chart again. Not sure yet what we'll pick, but we're going to pick the next thing to look at. And then we'll yeah, go from there and see if we find something else worth investing in. So far, I'm overall on average very happy. Like if we look at our last position, so since I started the Daily Market Mastery series, we had basically one trade or one position. So if we say 3 months, so we have now what episode number, what did we say? Episode number 24. There were some breaks in between for vacations and when I was sick a couple of days. But basically overall, we had our Alibaba position and Peloton positions that were relatively small that hit their stop loss. But on the other hand, our 2 other positions where actually we were able to take some profits, and currently, so Shopify and Domo, and currently are looking towards Domo to make more profit and Shopify to re-enter at the right price levels. So yeah, overall, I'm confident that even with our big exposure to the NDX and SPX in a negative way, so when they go up, our portfolio goes down, and when they go down, our portfolio goes up, that in the next couple of months till the end of the year, I should be able to easily make that minus 18% go away, simply based on the expected drop in the market that I'm, as said, expecting. And on top of that, by finding the few stocks that will not be affected that much by the drop, where we can benefit from upwards movement. Yeah. That's it for today. I hope we were able to take something away. As said, as a reminder, if you want to learn more about Elliott Wave Theory, you can always check out episode number 1 of Daily Market Mastery, or you can use the links in the description below to either read the Elliott Wave Principle book for free online, or get yourself a physical copy from the Elliott Wave International website. So the link is down in the description below. You cannot miss it. Thanks for tuning in, and even more so, thanks for copying my portfolio if you're one of the people that currently copies it. And yeah, see you all tomorrow with another episode of Daily Market Mastery.